Thank you for taking the time to join us for our company's financial results briefing for the third quarter of fiscal year 2025. I am Sogo, CEO of AnyMind Group. I will now proceed with the presentation. This slide summarizes today's presentation. Overall gross profit for the third quarter increased by 19% year-on-year, achieving stable growth. Even excluding foreign exchange effects, the growth rate remains the same. On a gross profit basis, the marketing business achieved stable growth of 14% year-on-year, while the D2C e-commerce business achieved high growth of 84% year-on-year. Although there was an impact from changes in the business environment within the partner growth business, we maintained year-on-year growth by sustaining the high growth rate of the business segment serving enterprise clients. In addition, operating profit increased by 16% quarter-on-quarter, driven by the increase in gross profit from the expansion of the brand commerce segment, which combines marketing and D2C e-commerce business. Regarding the progress toward the full-year financial forecast, as of the end of the third quarter, revenue, gross profit, and operating profit are all progressing at a pace exceeding the previous year's results. Net income is also progressing in line with the plan, at the same level as the previous year's results. The share buyback program was completed on September 22nd, with 1.25 million shares acquired for approximately 750 million yen. Regarding M&A, there were two transactions. Bibula in Vietnam has been consolidated since September 2025, and Nadeshiko Beauty in Japan, which conducts marketing business utilizing virtual influencers, has also been consolidated since October, the fourth quarter of fiscal year 2025. Next, I will explain the performance highlights. In the third quarter, revenue was 15 billion yen, a 14% growth year-on-year, and gross profit was 5.7 billion yen, a 19% growth year-on-year. In particular, we are achieving high growth in the e-commerce business by leveraging synergies with the marketing business. Although the growth rate of the marketing business has slowed, partly because we allocated internal resources to the e-commerce business, we are maintaining a high level of growth for the business segment serving enterprise clients as a whole. Operating profit was 517 million yen, a decrease year-on-year due to changes in the external environment for the creator growth business since March, but we achieved a 16% increase quarter-on-quarter. Business growth continues to be strong in our brand commerce business. The combined growth rate of the marketing business and the D2C e-commerce business maintained high growth at 34% year-on-year. Through operational efficiency initiatives, we have controlled headcount growth compared to the second quarter and are promoting the optimization of SG&A. The graph on the right shows the quarterly transition of our employee headcount, and while personnel in sales and business development are increasing as we continue to invest in future growth, the operation personnel headcount has decreased due to our initiatives to streamline operational efficiency. The total company headcount has also remained at the same level as the previous quarter. Additionally, gross profit per employee has been steadily improving. With our brand commerce business continues to grow and a continued firm control of SG&A, operating profit has shown an improving trend compared to the previous quarter. Internal AI adoption and implementation and global business process standardization are also progressing. However, we expect contributions from these initiatives to have a larger improvement on our financial results from the first half of the fiscal year, ending December 2026. In the third quarter, as the Japanese yen appreciated slightly against the US dollar, we recorded a non-operating unrealized foreign exchange gain of 31 million yen, resulting in a net income of 264 million yen. However, on a cumulative basis for the third quarter, we have recorded an unrealized foreign exchange loss of 340 million yen. I will now explain the summary of consolidated results for quarter 3. Revenue was 15 billion yen and gross profit was 5.7 billion yen, achieving year-on-year revenue growth despite changes in the external environment of the partner growth business. Operating profit and net income attributable to owners of the parent are at the levels I explained earlier in the summary section, where we made improvement on quarter-on-quarter basis. Cumulative progress for the third quarter, against the full-year forecast revised on May 14th, stood at 74% for revenue and gross profit, and 73% for operating profit, tracking ahead of the previous year's pace. Net income is progressing similarly to the previous year's results. Although it has been affected by foreign exchange losses incurred in the first half, it is progressing in line with the plan. These are the assumptions for the full-year financial forecast that were announced in the first quarter. As there have been no changes, we will skip the explanation for this slide at this time. This shows the quarterly performance trends. Revenue for the third quarter increased by 14% year-on-year, and gross profit increased by 19% year-on-year. Approximately half of our revenue is denominated in foreign local currencies. However, since the impact of foreign exchange fluctuations year-on-year was almost neutral, the growth rate remains the same, even excluding the impact from the change of foreign exchange rate. Next, let me explain our performance by region. In quarter 3, our businesses in Japan and Korea are showing strong growth, leading the group and increasing their share of total revenue. On a gross profit basis, Japan and Korea accounted for 53%, Southeast Asia for 37%, and Greater China and India for 10%. Regarding the growth rates shown in the graph on the right, Japan maintained high growth of 38% year-on-year, even as we faced changes in the global external environment. In Southeast Asia, Greater China and India, although the partner growth business was impacted by changes in the external environment, other businesses have continued to grow strongly. Looking at the regional growth rate of the brand commerce business, excluding the partner growth business, Japan and Korea grew by 41% year-on-year, Southeast Asia by 31% year-on-year, and India and Greater China by 18% year-on-year, achieving growth in all regions. Operating profit for the third quarter was 517 million yen. While this was a decrease year-on-year, it represented a 71 million yen increase quarter-on-quarter, showing steady progress in profit improvement. In addition, adjusted EBITDA was 1,101 million yen, an increase of 25 million yen year-on-year. This shows the breakdown of factors for operating profit changes compared to last quarter. Personnel expenses increased by 113 million yen quarter-on-quarter, a slight increase due to regular salary raises and the consolidation of Bibula starting in September. However, initiatives to improve operational efficiency suppressed this growth rate in personnel expenses to remain below that of gross profit. The 68 million yen increase in depreciation expenses is attributable to costs associated with office expansion, representing an upfront investment for headcount increases in growing areas. A portion of IT-related expenses is linked to e-commerce revenue, and as revenue increased, these expenses increased by 143 million yen as variable costs. In addition, other SG&A increased by 152 million yen. This was due to an increase in office-related costs associated with the office floor expansion and logistics and warehouse costs related to the D2C e-commerce business. This shows the quarterly trend for SG&A. The SG&A to gross profit ratio decreased slightly in the third quarter. Going forward, we will continue to control SG&A by promoting operational efficiency initiatives, improving productivity, and thereby curbing increases in personnel costs, a main component of SG&A. Gross profit per employee, a key indicator for measuring profitability improvement, improved year-on-year in the third quarter of 2025, despite the impact from changes in the business environment for the creator growth business. The figure excluding the creator growth business is also steadily improving due to progress in operational efficiency. Additionally, Bibula in Vietnam has been consolidated since September. Therefore, to accurately measure the quarterly impact, both employee headcount and gross profit are excluded from this calculation. Bibula's employee headcount at the end of September was 73. This shows the status of our balance sheet. In the third quarter, we raised additional interest-bearing debt, which was allocated to M&A funding and other purposes. Additionally, the total goodwill amount from 11 past M&A transactions is approximately 4 billion yen, and the ratio of goodwill to net assets is 0.24 times, maintaining a high level of safety. although cash on hand has decreased on a Japanese yen basis due to factors such as M&A. We continue to maintain a sound financial foundation. Next, I will explain the progress of each business segment. In the third quarter, our brand commerce business, which combines our marketing business and D2C e-commerce business, has continued to grow steadily. The partner growth business recorded negative gross profit growth year-on-year due to changes in the external environment. The gross profit margin for the entire group is 38%, excluding fluctuations due to business mix. There were no significant changes in overall gross profit margin. In the third quarter, the D2C e-commerce business achieved significant growth and strongly drove the overall growth of the group. As a result, the D2C e-commerce business share of both revenue and gross profit has surpassed 30%, as we are making steady progress in establishing a diversified revenue base. In addition, synergies between businesses are also strengthening. The combined contribution ratio of the marketing and D2C e-commerce businesses for enterprise clients, which are our growth drivers, to gross profit in the third quarter has steadily expanded to 75%, up from 67% in the same period last year. On a gross profit basis, the marketing business achieved stable growth of 14% year-on-year. Influencer marketing, which accounts for over 70% of gross profit, maintained strong momentum with growth of approximately 25% year-on-year. On the other hand, the overall growth rate for the business was 14%. This reflects the allocation of internal personnel to the higher growth D2C e-commerce business and the impact of conservative client budgets for digital marketing, mainly in Southeast Asia. Regarding the growth rate of gross profit by region in marketing business, Japan and Korea grew by 20%, Southeast Asia by 7%, and Greater China and India by 19%. In influencer marketing, we achieved stable growth exceeding 20% in all regions. The marketing area overlaps with the D2C e-commerce business within our internal structure. So we have prioritized and allocated resources to the D2C e-commerce business, where higher growth is expected. Even under these circumstances, we believe there are still growth opportunities. Going forward, to further increase the growth rate, we plan to expand solutions and networks specialized in focus areas within the influencer marketing business, strengthen end-to-end marketing support, integrated with e-commerce support for large clients, and further advance automation utilizing generative AI to increase the number of projects we can support. We view this as an area with continued medium to long-term growth potential in Asia, and we remain committed to investing for growth. In October 2025, we completed the acquisition of Nadeshiko Beauty, a company specializing in vertical short-form video marketing utilizing virtual influencers. Nadeshiko Beauty will be consolidated starting from October 2025. Previously, Nadeshiko Beauty acquired new customers mainly through inbound inquiries. However, by strengthening the sales structure within our group, synergy effects are already emerging at an early stage. Furthermore, while our company excels at marketing for brand awareness, we did not have our own beauty-focused media. With Nadeshiko Beauty joining the group, our solutions for the cosmetics and beauty domain have been further enhanced. Although they have just joined the group, Nadeshiko Beauty's monthly revenue is expected to significantly surpass its all-time high by the end of the year, demonstrating that synergy effects are already being realized. Going forward, we plan to improve content production efficiency by leveraging AI, while also expanding this same business model overseas. D2C e-commerce business grew by 84% year-on-year. The enterprise D2C segment continued to perform well, supported by collaboration with the marketing business, achieving 130% year-on-year growth. Following the second quarter, Southeast Asia is driving this growth, with Vietnam, the Philippines, and Thailand performing particularly well. In the Indonesian market, we obtained the Lazada Star Enabler certification, the highest partner certification from Lazada due to the company's high performance. Lazada is one of the largest e-commerce marketplaces in Southeast Asia. In addition, we are steadily expanding the business in Japan as well. The Creator D2C business achieved 38% growth by concentrating resources on high-profit brands. This slide shows the trend in the number of e-commerce brands handled and the revenue per brand. The number of creator brands increased slightly quarter on quarter, driven by the strong performance of the fitness D2C brand Lyft and the D2C brands of our exclusively managed creators. The revenue per brand has increased. For the enterprise D2C segment, we focused on acquiring new clients, mainly in Southeast Asia, and the total number of brands handled increased. Additionally, revenue per brand has also grown significantly, driven by an increase in large-scale projects across multiple regions in Asia and regional projects spanning multiple countries. The Creator D2C business is being driven by the strong performance of the D2C fitness brand Lyft. Lyft accounts for nearly half of the gross profit in the Creator D2C business, and its growth is driven by apparel sales through both e-commerce and in-store. Brand recognition is expanding not only through product sales, but also through multifaceted brand development, including gyms and cafes. Strong demand from inbound tourism is also contributing to store sales. Since joining the group in the first quarter of 2020, it has continued to grow steadily. Comparing third quarter revenue, it has achieved high revenue growth of approximately 5 times in 5 years. On this slide, we present case studies for our live commerce support. On the left is the case of Beauty of Josong, a Korean skincare brand. We utilized our AnyLive platform to implement a hybrid AI human broadcast model. By having human streamers broadcast during peak times, while AI automated the live stream during off-peak hours, we achieved over 250 hours of continuous monthly streaming. This resulted in a 56% increase in monthly GMV. On the right is a case study for Airy Gear, a Thai sportswear brand. We implemented initiatives on TikTok Shop, including a single 10-hour continuous broadcast by a streamer. This single 10-hour stream generated $200,000 in sales, and their weekly GMV on TikTok Live increased by 427%. These success stories are steadily increasing. We are successfully acquiring new customers and securing subsequent upsells, particularly in the live commerce sector, where demand is exceptionally strong in Southeast Asia. Gross profit for the partner growth business decreased by 11% year-on-year. The gross profit for the creator growth business decreased year-on-year due to changes in the business environment, while the publisher growth business remained stable. On a regional basis, while Southeast Asia, Greater China, and India experienced negative growth from these environmental changes, business in Japan achieved growth in both the creator growth business and the publisher growth business. The number of contracted publishers remains stable across all regions, with no significant changes. Ad unit prices continue to be weak across the market. However, gross profit per publisher remains stable, driven by contributions from improved operational efficiency and revenue growth in our self-owned media leveraging AI, primarily in Japan. Due to changes in the business environment, the number of supporting creators is in a declining trend. Revenue and gross profit per creator has decreased compared year-on-year due to changes in the business environment, but have remained stable quarter on quarter. Here are recent case studies for the publisher growth business. On the left, Daily Gadget is a web media that we operate internally. By leveraging AI, we have streamlined the article writing process and significantly reduced production time. Furthermore, affiliate revenue per article has expanded 4.4 times. We are also applying this media monetization expertise to our publisher client support. On the right is a case study of our support for Taiwan Family Mart. By utilizing our platform, we are advancing the enhancement of its value as a retail media outlet with 19.5 million app members. Here are case studies of business diversification in the creator growth business. If you look to the left of the slide, we're highlighting some fantastic work from the talent we manage. A perfect example comes from our subsidiary, Grove. They run the short film channel Shunkan Seju and recently released a 3-part videos set in the Tokyo Joypalace theme park. All 3 episodes have individually passed 1.5 million views as of the end of October. Also, Kasumi Mori, one of our exclusively managed talents at Grove, was named one of the Faces of the Year 2025 by Nikki Trendy, a very influential media outlet here in Japan. She is incredibly active in advertising and high-profile events. On the right, we introduce a case study of the YouTube Shopping Affiliate Program. This is a program where creators can earn a commission when viewers purchase products by tagging product purchase links in their videos. As an official YouTube MCN, we are able to support our creators to leverage this program. For instance, we have a success story in Thailand, where just 2 creators generated 110 million yen in revenue in only 7 months. In light of this success, we will continue to expand the use of this program going forward. Lastly, I will introduce our PMI track record for M&A executed after our IPO. We are particularly focused on M&A in the enterprise D2C segment. DDI, Arche, and AnyReach, which joined the group after our IPO, are each creating synergies and contributing strongly to the group's overall growth. The graph on the left shows the gross profit growth of the enterprise D2C business. As of the third quarter of fiscal year 2025, organic growth alone resulted in a 2.5 times increase in 1 year. With the additional contribution from M&A, the business as a whole achieved even higher growth of 3.4 times. The graph on the right shows the growth of these acquired companies. Comparing the quarter immediately after the 3 companies joined the group with the most recent quarter, their combined gross profit has doubled, indicating that PMY is progressing smoothly. Going forward, we will continue to execute M&A at a pace of several deals per year as one of the important pillars of our growth strategy. This concludes our presentation. Thank you for your attention.